Hey, it's Soleil, and this is episode 56 of the Red Pilled Orange Pill Investor. And today's a nice day for Bitcoin. It kind of doesn't matter when and how fast. I am operating under the assumption that Plan B stock to flow model is accurate, and for the next 18 months or so, until about October 2025, we'll probably be in the next bull market. However, the point of selling covered calls is the up plan is the same as the down plan. So again, the MicroStrategy has severely breached my strikes. I think MicroStrategy might have been 670, 685 maybe, and I built in about at least 5% call away value. So what is this, 15%? MicroStrategy at 15% since last week. Oh, sorry, that's the call. Yeah, almost 20%. So that's the downside. I would never say that this strategy is just 100% profit. There's no downsides whatsoever. You're basically trading upside for reduced cost basis, which increases your chance of success. And doesn't surprise me though, because when you start getting, I need to read trend following. That's in my TBR for quite a while. But when you get something that's reaching 52-week highs, there tends to be a little bit of a fever that goes along with it. So, back when 460, okay, it went decidedly above 460, and then it tested higher, tested higher, tested higher, tested higher, and then bam, you got 570, and you got 685. Resistance here, and I don't really do technical analysis, but I mean, I know a couple of basic words. So this is not technical analysis. I don't really do it. But this was obviously resistance. Tested, resistance a couple times, and was like, okay, that's all we're doing right now. And then bam, dropped all the way down to 450 support, which oddly enough was right about where it was when it took off. So hit 52-week highs, caught a fever, bounced off of almost 700, and then right back down to where support was. And now it's regaining again. And so we've, there's no guarantee that this will happen again. Like, okay, this little kind of building momentum thing, and then boom, skyrocket up, what, 50%? Like 250, yeah. No, not 50%, maybe 30, 40% to here. We're not guaranteed to have that happen again. This could be all we get out of it. But if we're hitting 52-week highs and then people, catch a fever right here, no telling where it could go to. And so if it does go up, will I be limiting my upside by selling a covered call? Yes, of course. But if the price crashes back down to 500, I'll be collecting $2,000 a week while it does it. So it's a trade-off. And it's my preferred method of trading. It's not financial advice. I'm just showing what I do. The only assets I really own are Tesla, Mara, and MicroStrategy on this account. Mara is another traditional covered call. Well breached my 2650, and I think we gave some pretty good call away value here. Yeah, it was like 10% call away value. Boom, it's up 13%. So yes, absolutely, we'll have, if I want to keep my Mara shares, we'll have to buy this back. I say we because I trade Mara every week, every Friday with my son as well. It's a nice little father-son activity. But we got paid $1, and it looks like we'll have to pay maybe $3.50 in order to retain these shares. And that's just part of the process. Tesla did not go crazy. I think it's up a little bit, but the leaps that I have is the 150. Yeah, so it's up $7. I think that's basically where it was last week. It's not terribly far off from where it was a week ago. So that's kind of the point. So made some money on the value of the leaps, but also sold the 205. So the value of my leaps is up about $700 and got paid $200 for this covered call. Now the fact that Tesla has gone up means I might break even on this, or if the price goes above 205, I'll have to pay to buy this back. But even the $2 I got paid, if this 205 stays here, I'm breaking even. So it's not like it even hurt me. And as long as you're constructing your poor man's covered call correctly, you will always make more on the leaps than you will lose when this breaches your covered call anyway. And so the deeper in the money you buy this, the better, or the safer. Not necessarily the better, but safer. So we've got a delta of 0.82. The closer this is to 1, the more it acts just like the stock. So, but the other benefit of Tesla going up makes this delta go up. So if Tesla would go up to 250, this delta might be 0.9. The cautionary tale, though, however, is when Tesla was here. No, that's 2023. When Tesla was here, and I think this is when rates started to go up, I had a lot of leaps in poor man's covered calls, and those are leveraged long. It's way more dangerous than just owning shares of stock. And so I actually, from here to here, I got absolutely wrecked. Absolutely wrecked. Almost blew up my account completely. The whole time I'm trading from like here to here, I gave all of that back from here to here. And that should not have happened. If I actually owned shares of the stock, that absolutely wouldn't have happened, because the worst case scenario, you just have 100 shares of your stock. So yeah, if I had 100 shares of Tesla, this would have been worth 40 grand, and it would have only been worth 10 grand here. But to a certain extent, It doesn't matter when you own the shares because you can still sell covered calls against stock that's worth $100. What you can't do though is sell covered calls against a 150 leaps. That's, the price of Tesla drops down to like 100. The price of this leaps is going to be like $500. You can't construct a poor man's covered call against that. It either there wouldn't be any premium available above 150. I can't imagine a scenario where you'd actually be able to profit off that. And so buying long options, you can get completely wrecked. So I'm not a financial advisor, but even if I was, I'm not sure I would ever recommend it. It's something that you definitely have to take very seriously. And so I put $6,000 into this, and my total, account is worth 8 times that. So I have 1/8. If I get wrecked on Tesla, I could lose 1/8 of my buying power, of my account value here, which is 12.5%. So that's not that would hurt, but it wouldn't completely blow up my account. So I would still have shares in these other stocks. Oh, yeah, I forgot about HUT. Let's see, HUT breached my strikes as well. I bought in at around $8 a share. I've got an 8 and an 8.5. Yeah. So with MicroStrategy, having to buy my MicroStrategy covered call back, depends on how much buying power I have here. This is a fairly, I'm not in panic mode here. 20% of the account value is my buying power using margin. That gives me a little bit of breathing room. I will probably be very conservative purchasing more shares, and so would even consider selling some shares of HUT, or just not buying as many. Like when I roll MicroStrategy, I'm going to have to buy it back for 8,500. That's like all the buy power. And then at current prices, I might make 2,500 or something for next week. So would still have to use about $5,000 of buying power. Yeah. So depending on depending on where MicroStrategy settles next week, I may be liberating these shares of HUT right away, just to have a little bit of breathing room in case MicroStrategy pulls back again. All right, I think that's a good place to leave it. Be good, y'all.